All right, folks, welcome to Investing for Beginners podcast. Today, we're going to talk about back to the basics. This is an on again, off again series that we've done through the years, and we just like to touch up on basic fundamentals of investing. And it's always good to kind of give yourself a refresher on the fundamentals, as my sports teachings, coachings always focused on fundamentals, pitching, dribbling, that kind of thing. It may be boring, but it's essential stuff you need to know. So we won't make it boring today. We're going to talk about some core investment principles that you have to kind of have your head around if you're going to invest in the stock market. And the first one we wanted to talk about was buy low and sell high. And maybe let's talk about this rule and maybe why it's hard to follow and how you can implement it. So what are your thoughts?
That's the rule, right? Just buy low, sell high. Just buy it when
Super
it's
easy.
down and sell it when it's up, and you're going to make money, right?
All right.
Obviously, the stock market's not that simple. If you really want the breakdown of why stock market's special, over the very long term, it does very well. But in the short term, things go up and down. So when you try to think about buy low, sell high, I think one of the risks you can come across as an investor, and we might all feel the appeal, whether you're day one or day 1,001, trying to time the market, trying to think like you know what low is and what high is. Because in hindsight, we all know when the buy low option was, when the sell high option was. Like we all can see it clearly in hindsight, but the future is never that clear. And so you have to be careful with the buy low, sell high. Yes, I practice it. Yes, I buy stocks when they're cheaper than they should be. I do buy low, but I don't play the sell high game. I'm still in the building stage. I don't try to play the buy low, sell high game from a timing perspective, and definitely not trying to jump in and out of the stock market, because that can be a great way to lose money.
All of it.
Not all of it.
Maybe not all of it, but it is a great way to lose money. And let's talk a minute about the whole myth of timing the market and why it's so hard. And to me, it stems from one simple thing. We don't have any idea what's going to happen in the future. Zero, zip, zilch. You can be inundated, especially at the beginning of the year, of people making predictions, prognostications. This is going to happen and this is going to happen. And periodically they are proven right. But is that skill or is that luck? And I would argue it's probably way more luck than it is skill. I'm not saying these people don't know a thing or two. They certainly do. But by and large, we don't know what's going to happen in the future. And if you're deluding yourself that you think you do know that when you buy this company that it is going to go up after you buy it, for sure, yeah, okay, you may get lucky and it may happen a time or two, but I would say if you pick 20 companies, it's probably only going to happen one or two times. To me, that's one of the biggest myths. And confirmation bias for me on this whole idea is when you think of the greatest investors in history, we can all name them. When you list those people out, none of them were market timers. Zero, zip, zilch, nada. Nobody. There are no market timing billionaires. They don't exist. Yeah. And so when you think about, oh, I could time the market, no, you can't. Just not to be negative Nancy, but you can't. Yeah. And it's impossible. And will we get lucky? And like Andrew said, will we buy at a really good price, low, because we've done all this work? And if we do sell it, do we sell it at a higher price? Sure, that's great. But is that something that you can time? No.
Man, that's well said. The billionaires thing too, right? Like there really aren't. Like
no,
none of them go out there, because there's plenty of billionaires that will give their opinion on how the rest of us should make money like they do. You don't hear market timing.
No, you don't. I mean, even the people that are in the Bitcoin space that talk about they have bought it at a lower price and they've held it all this time, and that's how they got rich. I'm
Yeah.
not suggesting people go out and invest in crypto, but the same rules apply. They aren't buying, they aren't timing the Bitcoin market and buying and selling and getting out. Maybe there are a few people that have gotten lucky, and you see those examples when they're trying to sell, hey, do this like I did. Okay, they got lucky, and that's great. But even in that space, they bought low and they held on.
Yeah. So what's the antidote then?
What's the antidote?
Yeah.
To do what we have been trying to teach people for the last 7+ years, right? Like I heard this quote once. It was in the movie Remember the Titans. When Denzel Washington's character is talking about his playbook, and the veer, he says it's like Novocaine. It takes time, but it works eventually. So it's kind of the same idea. You gotta do the work and understand the businesses and find the right businesses and buy them at a good price and hold on to them for a while. They're simple rules. They're not easy, but they're simple.
Yeah. And having a plan in place that keeps you from, so I think, yes, the market timing obviously is an issue and trying to jump in and out, but even actions that you don't realize is kind of like a market timing, like, oh, I'm just going to wait for things to come down. How much missed opportunity has there been from retail investors who are just waiting for things to crash before they dive in? Trust me, you'll wait for a long time. I mean, to Dave's point, you might get lucky. Maybe you wait 6 months and it is the big crash and hooray, like you made an extra 20% on your money. Good for you. But if you have a lifestyle of I'm going to wait for the crash every time before I jump in and find those businesses and invest in them for the long term, I don't know about that.
Mm-hmm. Yeah, it's hard. In some ways, it's probably harder mentally and psychologically to think about when the market is going down to jump in and then to hold on when the market is going up, because it's harder to sell. You feel like if I sell now, I'm going to lose out on gains. And, it gets to nosebleed levels and you're like, how do I hold on to this? So the psychology of all that is very, very hard.
I'm glad you brought that up because that kind of goes to why these rules are so important and why it's important to try to fight against it, because you are literally fighting against biological impulses. You're fighting against the emotions. You're fighting against fear. Oftentimes people talk about the stock market, fear and greed are in the market. How many times do you fear either missing out on something or you fear that if I sell this, I'm going to regret it later? And that can drive what would otherwise be a very rational, logical buy or sell moment. But when it's fear-based, because you have a fear of regret, you have a fear of seeing this thing go up and you miss out, that can also hurt you as an investor and make things a lot more difficult.
Mm-hmm. Yes, for sure. And I think to offset it, it goes back to having a plan and working the plan and being consistent and utilizing or exercising patience. And I think if you can learn to manipulate those skills, it'll improve your investing returns dramatically.
Yeah, I'm getting really impatient of my ability to learn patience.
Right.
I want to be patient already. I'm getting impatient on that.
I'm getting impatient learning to be patient. Yeah, for sure. All right. So another core principle is the whole magic of compound interest. So when you hear the word compound interest, what does that mean to you?
Yeah, like I was talking to Evan the other day on the show. Compound interest is just a snowball that rolls down the hill, and that is your wealth, your little wealth snowball. As snow rolls down the hill, the amount of snow it attracts becomes bigger and bigger. And as it's even a more massive side, it's attracting even more snow. Compound interest works the same way. Businesses in the stock market work the same way. And those are two very, very powerful things. When a business is big, it's able to do big business things and then continue to grow, and businesses can kind of build on their success. And you see it. I mean, some of the most obvious examples are the biggest, most well known businesses we know today. Look at a company like Apple. Apple started as a computer company, but they compounded all the knowledge and the technology that they had built into the iPhone. Microsoft took Microsoft Office, compounded it into the cloud. So there is, incremental compounding year after year with profits and reinvestments and growing from 10 stores to 11 stores to 15 stores to 20 stores, and that all compounds. But there's also compounding, kind of big picture wise, just how companies invest. And then you have the whole compounding on the investor side too, the way your investments compound as the businesses compound. And that's really exciting as well.
Yeah, it's super exciting. And I think the greatest example of this for me as an illustration has always been Warren Buffett. And you think about, yes, he's been investing for a very long time, and he's one of the wealthiest men in the world. But he really didn't really start to see those insane numbers, the monopoly money numbers that you kind of think about now. It's really started for him once he turned 60, 70 years old, and it continued to skyrocket. And you can see different images of how that's played out over the years on the internet. You can Google Buffett compounding, and you'll see these charts that are hockey sticks, just up and to the right, and just huge growth because, to your point, his wealth stems from his ownership of Berkshire Hathaway, which the value of that has just compounded over time for many, many decades. And it's just gotten bigger and bigger. And that as that snowball has rolled down the hill, it's gotten bigger and bigger and bigger. And as a matter of fact, one of the greatest books written about him is called Snowball, isn't it?
Yeah. Alice Schroeder, Snowball.
Yeah. So, I mean, and I don't know this for a fact, but I'm speculating that she came up with that idea because of how he's grown his wealth. And that's a good illustration of how impactful this could really be.
Yeah. People get so impatient. They look at the NVIDIAs of the world and be like, man, I wish I 100x to 200x my money. 10% doesn't sound like a lot. When you only have $100, 10% is not much. But 10% of $1 billion, it's the same 10%, but we're really talking about two different things. So investing is super powerful, to your point. Also, being an investor as a skill set is something you can take with you as those numbers get bigger. And, one of the things I think you've said a lot on the show over our 7.5+ years is knowledge compounds. So imagine how exciting is that? As your own personal pile is getting bigger and compounding, your knowledge and skill set's getting bigger. Ideally, theoretically, hopefully, you're making better decisions the more money you have. And that excites me. I'm a dreamer. I can't help it. But that part, yeah, that's exciting.
It's very exciting. I think to me, it's one of the more exciting parts about the whole investing journey is just the knowledge that you pick up and the things that you learn. And it definitely applies directly to the choices you make on what companies you choose to invest in, but it has tangential benefits outside of that as well in your life, and how the things that you learn, you can use those skill sets to learn a particular thing, and you could adapt it to learning how to fix a door, for example. Maybe that's not the greatest example, but it's what sprung to mind. So, but those kinds of things is what really excites me. It's about the building of your knowledge, and that definitely compounds. I think back on our early days, and I look back and think about, okay, I had to think about certain things, and now because I've used them so much and I understand them so much better than I used to, that now it's kind of second nature to talk about something like return on equity. Whereas 10 years ago, I had to think about what is the formula. Now I don't have to think about it. And it's just because of the knowledge that's built up over time. It's a simple example, but to me, it illustrates how much that can compound, just like our wealth can.
Hopefully, it's motivating to know that both Dave and I did not go to school for finance. Mm-hmm. We taught ourselves helping each other through the more difficult parts, and it was a process. It was not something we did overnight. It took us many years. And I still remember in the early days when I didn't touch banks because that was too risky for me. And now I feel like a
Right.
fool even saying that. I mean, they can be risky, but yeah, I mean, that was a
Yeah.
flawed mentality.
Yeah. Right. Yeah. I mean, it's just, I wouldn't touch semiconductors. It just baffled me. Didn't understand it. But Andrew helped me, get a really good handle on how semiconductors work, how the actual semiconductor works and the industry and all those things, because he had a lot more insight into it. And it taught me a lot. And now I feel comfortable enough that I could talk on a podcast about semiconductors. Am I an expert? No, but I certainly am a lot more knowledgeable than I was 7 years ago, for sure. And so those are just really simple examples of how knowledge can compound, and you can do it too. You just have to put in a little bit of time and a little effort. And it's the same with investing, putting a little bit of money and time into it. The time and pressure are the two things I think Morgan Freeman talked about or maybe not Morgan. Yeah, maybe it was Morgan Freeman in Shawshank Redemption. They were talking about the hole that he dug, time and pressure. Those are the two things you need to dig a hole like that. And it's maybe not the greatest example, but those are the two things you need to build compounding. Is time and pressure, time and knowledge.
Hey, I love these movie references. Please keep it going because now you're giving me a to-do list for the weekend.
Yeah, I don't know where it's coming from. All right, so let's move on to the next principle. So this is risk versus return. So kind of understanding like the investment seesaw and how it has to be a core principle of how you think about investing. So what does that mean to you?
Lots of things. If I was just getting started for the first time, the big one that I'm glad I learned early, and I'm glad I happened to stumble on it, so I didn't have to learn it the hard way. But this idea that, sidebar, I think this is just part of when I came up as an investor. When I first started learning about it, was 2012 time period, and people were very, very scarred still. The stock market was not like it is today, where people think of it as a happy place. A lot of people liked gold and silver more than stock market. Like stock market had gotten destroyed from the great financial crisis. So what I learned back then very early that people were talking about was the whole Enron situation was a big one. WorldCom was a big one. So what's kind of crazy if you weren't an investor in that time to realize is that Enron was actually the company. Like their leaders were all in the business media. They are on, Time Magazine or, newspaper this, probably CNBC that. They were looked at as, man, this is the best CEO, business leadership, best business to work for, all these things. And what's sad is a lot of people had very publicly said, I'm putting my entire 401k in this company. And obviously with hindsight, we know how that story ended. But to me, that it's such a visceral idea of just a company who everybody adores can just get wiped out like that. And that's why diversification is so important. That's why spreading your bets. That's why making sure all your eggs are not in one basket. Because I don't care how good the company is, how great they've done, how much money investors have made from it. You don't follow diversification, it's unlikely to end well for you. Some people get lucky, some people never have to worry about it, but over the majority of people, over a majority of cases, you want to be diversified.
Mm-hmm. Yes, for sure. I mean, I think that those are all great lessons, right? And I think when people start investing early in their journey, they don't really understand that the dichotomy is the upside is unlimited and the downside is zero. You can lose everything. And I think a lot of people don't realize that can happen. It doesn't mean it will, but I think people go into starting investing as, yeah, I understand that the market doesn't always do great and blah, blah, blah. And I may not make as much as I want, but they don't think about the absolute bottom of I could lose it all kind of thing. And we haven't had really a big bankruptcy shake the market in a while. And so I think that lesson has been lost through the mists of time, if you will. And I think everybody also gets a little bit too irrational exuberance idea. Newer investors usually don't wade in until the market is really hot and everything's going great and everybody's talking about it. You know, you get in an Uber and the Uber driver is talking, "Hey, have you checked out this stock?" And you go to work and you hear your coworkers talking, "Oh, I bought this yesterday and I bought this yesterday," and everybody's making money. And so you wade in not understanding what you're really getting into. And you have to keep in mind that no matter how great every business you think is, there's always a risk. There is no free lunch, as Andrew likes to say. There's no free lunch. And there's no absolute, I'm going to buy this and I don't have to worry about it ever. I'm not saying you have to worry to the point where you're obsessing and laying in bed, not, sleeping, but you at least have to do some due diligence before you put your money. You think about how hard you work for that money, how long it takes you to make that money, and then you invest it with a company. You want to make sure that you're putting your money where that person's going to take care of it for you. And that's the beauty of the stock market. But we have to do a little bit of work and understand that there is a risk when you invest. There is no guarantee that, I buy this and it's going to make me lots of money. Yeah, hopefully that's the way it works out, but we still have to do our due diligence and understand that risk is part of the game. It's part of the equation of investing in the stock market.
Yeah, that's very well said.
Thank you. All right, let's move on to the last core principle, and this is dollar cost averaging. And think of this, I like to think of this as the tortoise usually beats the hare, and why.
Mm-hmm.
And so we've talked before about dollar cost averaging. Maybe we can kind of chat about it some more. It's a really powerful thing, and it's not probably talked about enough, even though you and I have talked about it a fair amount. It's still not really a part of a normal conversation when you talk about investing with people.
Probably multiple reasons. The one that's popping in my head right now, though, and this again goes back to the way we are wired. And don't feel shame if this is describing you. This is, again, just how we are wired. I've noticed with myself, I will get more excited or more unexcited about something that doesn't matter as much. I'll get more excited about something that doesn't matter as much if it makes me feel smart. Let's say that. Or if I buy a new stock, let's say I bought, everybody knows I bought Adobe recently. So I hyper focus on how is Adobe doing. And if it's up, I feel better about that. Whereas PulteGroup, which is a bigger position, I don't care too much if that one's up, right? Like, because it was from so long ago, even though the Pulte thing would impact my net worth more. So I'm presenting those examples to show that, like, we can trick ourselves into wanting to feel smart. And I think not dollar cost averaging is a way to make yourself feel smart, because we all imagine this great moment, game 7 of the World Series, we're down by 3 and we hit a home run to score 4 and we've won the game. We imagine the stock market that way too sometimes, where it's like, I want to hold 30% of my portfolio in cash, and then I want to wait for Apple, Amazon, Google, and Netflix to all crash 80%, and then I'm going to deploy all my cash, and I'm going to look like a genius because I'm going to have all these 10 baggers in my portfolio. Like, this sounds extreme, but in a way, a lot of us can succumb to that. It's a way to try to outsmart the simplicity of dollar cost averaging. The downside, hopefully it's obvious, but if it's not, the downside is you are waiting and waiting and waiting and waiting when your wealth would have been better spent. Just put it to work. You don't have to put everything all at once, but you just incrementally, habits over time, over time, over time. And then you look back 10 years later, and it really wouldn't have made much of a difference whether you had that downturn or not. Definitely not 20 years, 30 years, 40 years later. That habit wins out. And it doesn't give you those illusions of being in game 7 of the World Series. And so it's not natural to do. And that's where the discipline can kind of come in and assist you as an investor, even though it doesn't feel great.
Well, and it's not sexy, right? It's
Right.
like it sounds better at dinner parties to say I waited for all those basket of companies you were talking about for them to get to my price, and then
Right.
I pounced,
Right.
and then it all went up, and like you said, it make yeah, right.
What a
It
guy.
makes you feel how smart are you? Everybody should invest like you.
Yeah.
I'm not saying that you can't be successful doing it that way, but I think we established early on in the show today that there's a lot of challenges, there's a lot of hurdles to trying to do it that way, and there's a lot of opportunity cost. How long do you have to wait for those companies to fall to that point before you dive in? And if you're curious about this, something that I have looked at in the past, and I haven't really come to a lot of conclusions, but I think it's a really interesting kind of data point to look at. If you look at the PE ratio of Costco over the last 10, 15, 20 years, it's always been high, 30, 35, 40, 50, all very, very high. If you compare that to the stock chart of the company, it's been up and to the right over that exact same time. It's beaten the market, had great returns. And I'm not telling you to go out and buy Costco by using this example. I'm just illustrating that sometimes you could wait forever for a company like Costco to come to your price, and you would have missed out on the opportunity to invest at any point along the journey of that company. And so the point is that sometimes the best opportunities are right in front of you, and a lot of times it's companies you already own, and we get so fixated on the shiny new thing. Andrew was kind of illustrating that point with, I bought Adobe recently, so I'm putting all my attention on that. But Pulte Group, which I've owned for a long time and has had great returns, I don't care at all. And so when you think about, okay, what do I want to buy next month? Well, a lot of times the best investment is Pulte Group, maybe not necessarily Adobe. I'm not saying that those, I'm just using those as illustrative points. But my point is, I think Peter Lynch might have said this, is a lot of times the best opportunity is the one you already own. And dollar cost averaging is a way to take advantage of those opportunities. And the power of dollar cost averaging is that it takes some of the emotion out of what you're trying to do. We talked earlier in the show today about emotions and how they can impact us. And by using a strategy like dollar cost averaging, buying on the second Tuesday of every month, I'm going to put $150 in. It may be a new idea, or it could be things I already own. And that's awesome. The bigger part of that equation, like Andrew was saying, is the consistency. Every Tuesday, the first Tuesday of every month, I'm putting in $150. You do that over a 30 or 4-year period, you're going to like what's going to happen at the end. I guarantee it. And so therein lies the power of this. And if you think about your 401k that people all hopefully invest in, if you have the opportunity, that's exactly what they do, is they take your annual contribution or your monthly or weekly or however they do it, and they dollar cost average into the choices that you have, whether it's 1 or whether it's 10. And so why wouldn't we utilize the same strategy in individual stocks in our portfolio? That to me is the power of using something like dollar cost averaging.
I love it. I love it. And I love the guarantee, because I will stand by that as well.
Yeah. Yeah. I agree. Along with the idea of dollar cost averaging, maybe we should add to our core principles today the idea of long-term investing. And I know this is right in your wheelhouse, so I'm going to set you up for the dunk and let you take at it.
Thanks. Yeah, I mean, it really, when you talk about, we've talked about compounding, you've talked about the 20, 30, 40-year time period, and how being consistent and having that habit will turn out great for you. It doesn't happen without the long-term piece to it. Going back to, I started learning about investing in 2012, because investing timelines matter. So back then, if you were, let's say, retiring when you were 2008, 2009, 2010, and you had all your 401k in stocks, it's not a good place to be, especially if you're depending on most of that money. Everything we talked about today, it all comes with the understanding that long term is so critical here. Because with the stock market, you can come across these big crashes that happen once every 10, 15, 20 years. And so, yes, if you buy something and hold it for 10 years, you'll probably make a good return on it. But if you buy and hold stocks for 15 years, 20 years, 25 years, the longer you hold it, the better your returns are likely to be, because you will have come across multiple peaks and troughs. So I'm kind of rambling here, but I hope to communicate that the point is long-term investing is successful, it's impactful when it's actually treated as long-term. Dollar cost averaging as part of a long-term investing strategy works when it's actually long-term. If you are close to retirement, if you expect to need the money in the next 5 years or less, any of those situations, all the things we talked about don't apply. Do not put money in the market that you are not willing to lose and let ride out the ups and downs. With that mindset, with that long-term focus, you will find the power of the market and the power of compound interest. But like Dave Ramsey says, he's like podcaster OG in our space. You only get hurt from a roller coaster if you jump off. So there will be ebbs and flows. There will be ups and downs. There will be bear and bull markets. If you don't have that kind of a time frame, adjust accordingly. Make yourself more conservative so you're not all in stocks. Do those type of things, and that makes sure that what we've talked about really makes the impact that you're hoping for.
Awesome. All right. Well, with that, we will go ahead and wrap up our conversation for today. I hope you enjoyed our Back to the Basics episode and the core principles that we talked about. If you adhere to these, you will start to find success in investing. I guarantee it. And with that, we will go ahead and sign us off. You guys go out there and invest with a margin of safety. Emphasis on the safety. Have a great week, and we'll talk to y'all next week.